So welcome to our 2018 financial benchmark review. We have Melissa Dick with Atlas Consulting and Accounting with us. Many of you have met her multiple times in the past. They've been doing our benchmark pretty much since inception with input from the CFOs to make changes and adjustments. Melissa is the explainer and Shane is the compiler. And they have done a great job for us. They were contractors in the past, so they know our industry, they know our business, and we are grateful to have them with us. So I am going to turn the webinar over to Melissa so she can go over the 2018 benchmark with. All yours, Melissa.
Thanks, Jan. Hi, everybody. So today I want to treat this just a little bit differently than I have in the past, and the reason why is because 2019, for some reason, has seemed like it's been really, really busy. It's even started at the beginning of the year, I even classified that the word was behind. And in other years, I honestly felt like there was a period I caught up, and even in the fall, I felt like I caught up. For some reason, 2019 has been a little bit different, and I'm assuming that you have felt this. So because of that, I want to use this time together as like a workshop. So I hope you have your benchmark in front of you. If you don't and you've got the little summary sheet, that'll work too. And what we're going to do together is I want you to spend the time to go through your benchmark as though you're working. We're going to use this 30 to 45 minutes to work together. And I'm going to give you some assignments and things to look at. And we're going to just try to not make this so presentation-y, but more of a let's get to work. Okay, I'm clicking the button and nothing's happening. Just a second. We're going to try it again. There we go. Okay. So here's how I do it whenever I'm looking at a benchmark and I'm preparing to pull all of the pieces together. I joked that over 40, there's some statistics that say if you're over 40, you actually prefer to have a piece of paper in front of you instead of the computer screen. I'll let you choose. If you want to pull up your computer screen and split me, that's cool too. Whatever it is that you can use this time to actually go through it, highlight it, write all over it, circle the things that you want to. This is going to be more about your time, and I'm just going to be your guide for you to get through the benchmark. The first thing you get is an assignment. Don't you love it whenever you start with an assignment? As we move through your benchmark today, I would like you to come up with just 3. I'm not making you do 5, I'm just making you do 3. Find 3 ratios, statistics, some piece of information that you would like to continue tracking. And here's the homework assignment. In 1 year, if you can believe this, in 1 year, our financial forum is already scheduled. And so that means we have this beautiful 12 months where we can each test tracking something for the full 12 months. So this timed out beautifully for our accounting group. That's why you're getting an assignment and the benchmark, and we're going to try to pull it all together. So I thought this would be great for all of us because we could treat it like a workshop, treat it like just part of our day job, because I know that you probably haven't even had time to look at this if you're anything like our clients and certainly us. I'm going to give a little bit of history of the benchmark if you're new to the benchmark, and also talk to you about how it's built. As Jan mentioned, years ago, Shane and I were on the contractor side of the Unified Group, and we're very happy to still be involved. We've been involved with the Unified Group for, gosh, I'm guessing almost 15 years. And what we found as members is we had this beautiful situation where we had the ability to learn from our peers. So then we said, well, what if we could have financial data and we could know where to go to get help, get the support, get our questions answered. And we realized that the financial benchmark could be an equalizer for that or a conversation starter. Not only do we get the financial information, but then we get the access to the people that actually know how that machine behind the numbers is working. And for us, benchmarking was very important in our business because we had members of our management team saying things like, well, you know, a 9 debt to equity is fine, right? Not knowing that that was actually bad. And without a number to compare to, it was hard to figure out what we wanted our people to talk about, what we wanted to do in the business, and also how to convince them that we needed to do some things to improve areas of our business. The nice thing about our industry is we're naturally competitive. We actually like to keep score. So the benchmark is a perfect example for us, and we're lucky that we have the ability to then drill into the numbers, drill into the operations at our peers, and get even better because we're doing this all together. I'm going to talk very briefly about how it's built, and the reason why I'm going to bring it in right now is if you find something that you would like to add or change or modify in the financial benchmark, can you make a note and give that to Jan? We make changes every year. The template is built by the Financial Steering Committee. It's not Shane and Melissa. This is your template. This is your information. And we want to be able to provide the best information that is meaningful for you. The template has grown, the benchmark has grown, and that's all because of the members asking for something in addition. We love it, and keep the ideas coming. After the template is created at the beginning of the year, it is sent out and you are assigned a company number. You then fill in the template and you'll send the template in. Once all of the templates are in, Jan sends them to us, but we don't know who you are. All we know is you're a company number, and we compile all of the data that you have submitted, and it becomes the total unified group performance. This is the one company, and here in a minute we're going to pull out our benchmarks together and we're going to look at it, but this becomes just the overall company performance. Then we will add on and add some slicers into the benchmark, but our goal is to keep it confidential and then be able to provide a baseline data that you can compare yourself to. In the beginning, we used one, and then we found through mixes of trials and errors, we got to the point where we created the revenue slicer, which seemed to be the best one. So that gives you an idea of how to compare yourself and then to identify how you want to ask questions. So we have 3 boys, and we do a lot of Venn diagrams in our house. So I said, here's what you're going to look for. If you've got your printout, if you've got it on your other screen, you're going to look for things that you're the same on and then things that you're above or below. So think about it as a Venn diagram for benchmarking. If you are above or below, it does not mean that you've done something wrong. It may mean that you need to investigate what's different. There are a lot of things within the template that each company can handle individually, and that means that you may want to understand just a few more things about how it's built or how the data goes together versus making the assumption that it's good or bad. Okay, pull out your benchmark, and I've got one in front of me too, so I can help walk through that. The first thing that you have is your balance sheet, and you'll see that you have 3 columns. So the first column is you. This is the information that you submitted on the template. And then you'll have a comparable revenue slice in the middle, and then clear to the right is all the companies in total. And then as you move through it, you will get the income statement, ratios and statistics, graphs, and then if you get stuck, we've got the definitions and summaries at the back. You can see our membership contribution has grown over the years. And also we were asked to split out open shop versus union so you can understand how those numbers pull together. Those of you that know me know that I'm kind of nerdy, maybe not kind of, maybe really, and that I love the balance sheet. So whenever I know that everybody has these conversations in their home, but in our home, we actually have had the conversation, what's your favorite balance sheet or what's your favorite financial statement, because 2 accountants in the same house. Well, my favorite is the balance sheet and Shane's favorite is the income statement. So I'm in charge today, so we're starting with the balance sheet. The balance sheet that I have in front of you is giving you the 5 years worth of data. You could also compile this information with the previous benchmarks, that this is the only place that we have the 5 years so you can see the trend. You'll also see that these are common sized. It's a lot easier to look at ratios than it is to look at the big numbers. And because we have a wide variety of revenue sizes and company sizes, it's easier to see it on a common size. There's a few things I want to point out on the balance sheet. Overall, we have such a strong group of companies. So I want to say that first off, we have a very healthy, unified group mix. So whenever you think about how this group does, you can say, if we perform like the group, we are healthy. And that's a big statement. That should make you feel good. If I'm going to add on, and I will as we go through the benchmark, I'm going to add just different things that I see. So Shane is the one that compiles all the information, and I read the information. So you get a Melissa-ism of what does this mean, at least whenever I look at it. I've looked at construction financial statements for over 20 years. That's all I do is construction. It's all I've ever done in my professional career. So this, these financials tell me a story. The thing that I thought was probably the most interesting on the balance sheet was actually accounts receivable. I think it's interesting that for 5 years, we're running 55%, and in 2018, it drops. Now, it's not a substantial drop, but I was expecting to see it, maybe all in cash, which then I'm totally cool with. But it actually is split up into various categories in 2018. I also have the luxurious position of being in 2019 and able to look back. And for many of our contractors, whenever we got towards the end of 2018 and into 2019, there was a lot of backlog that just couldn't get done. There were a lot of reasons why, but we found that in at least our large region that we work in, a lot of our contractors were feeling behind. I think I used that word before, but they were behind. And we also believe that part of that is showing up in this accounts receivable, where we just couldn't get the work done and billed to our satisfaction. Our current ratio is something we're going to look at in a little bit. Our current liabilities are a total of 76.4. I actually couldn't fit it on the screen. So, and then current assets is 76.4, and current liabilities is about 41. So we have a real nice working capital as well. The other thing I want to point out on the assets is this other down here. I can turn on my little writer. I forgot about that. This one has thrown off a few of our companies in the past because they don't have a large other asset. And so if you are one of the people that don't have a large other asset, you're going to probably see some differences in how this lines up. These other assets are largely coming from intercompany receivables. So they're part of a brother-sister corp or a parent subsidiary. They've got some other assets that are really non-operating. Or there's been some sort of a transition within the organization. We found that both of those have contributed to this other asset growth. I have to undo my writing tool so I can go to the next page. Here is our liability side, where we again have common sized. Just a couple of things to point out to you. We are overbilled. We have been consistently overbilled. When I see a contractor that's overbilled, the first thing I think is they have good billing practices. This group has good billing practices. The other thing that was really interesting to me is to see the growth year over year in our equity. That's a pretty big jump. There's a few things that will contribute to this. Of course, we are a money-making group, which is awesome, but that also means that we actually retained a little bit more this last year. That could have something to do with just how things timed out at the end of the year, or it could have been on purpose. I just found it interesting. We actually see a few of these things coming forward in some of our ratios. Told you I would pull just a few ratios. So in your benchmark, if you go past your balance sheet and your, I'm just dropping all my pages, balance sheet and your income statement, you get into some, I just call them statistics. They're just some raw data that you can use in the future for some additional mathematics if you like. If you go to the 5th page, you'll start to see those ratios. So we're going to work really all through this, but we're going to focus right now on the liquidity and the efficiency ratios. I just have 3 years. I don't have anything to say on the current ratio other than I like to see 1.2 and above. That's kind of my minimum is 1.2. Look at us, 1.8. Wow, we're doing great. This group does a good job of managing cash and managing working capital. Now we're going to look at the days sales, which is really just looking at bits and pieces of the efficiency ratio. I've got a few things that I pulled out and then some math I'm doing on this one as well. Again, we're still looking at these 5 years. You're either going to look at 3 or 5 year trends depending on what the topic is. And you can see our AR bumped up a little this year. Well, that stinks. This is common. Actually, just this morning, I was reading about the effects of the payment stream in construction and that GCs estimated it cost them $64 billion in slow payments, I'm assuming in interest. This is a trend we see in construction as a whole, that AR is a little more difficult. And then we're seeing it also in the unified group. We've done a good job. We tried to stretch our AP and we were able to keep our same net days over the 2 years. It means we're working. We're trying to make this work. We're doing what we can to keep cash flowing. Unfortunately, that still means that we are a bank, on average, 26 days. Which brings me to a conversation I had with a unified group member, I think 2 years ago. And what he asked is, can you give us a list of levers? He called them levers, so I'm going to call them levers. Levers that you could move or change in order to affect one of these ratios. I'm not doing all the ratios. I'm not giving you all the levers. I'm giving you an idea because you guys are my accounting group, so you're going to immediately understand and gravitate towards this. So I'm going to give you an example, and we're going to use our days as our example and these levers as the discussion. So each one of these can have some sort of an effect on our days. We're going to focus on the AR days because they grew by 3 days, and we know as an industry we're struggling a bit in that area. Okay, of this list, where would I start? Well, I would start with billings. I would start with actually even, are we over or under billed? If I can identify that, I can get past whether we have some billing procedure questions and whether we need to go to customer mix. So our group, the unified group, is already net overbilled. So I'm going to assume that we have good billing practices. We don't have trouble getting the invoices out. So then that brings me to my AR days. Well, what would be going on in AR days? It could be customer mix, it could be customer terms, it could be various things. And so I would then look at what makes up these AR days. How am I getting paid? Is there anybody I need to negotiate with? And then, of course, the one that can be real nasty is retention. And it could be that all of this, even getting to the 82 days, is actually all based on retention. Now, I can't speak for each person, but I can tell you that for us, whenever we're looking at statistics and ratios, we try to dig into what is the root cause or what are we trying to adjust or fix, or in our unified group members' words, what is the lever that I can pull or push to make a change? As we go through this, if you've got a ratio that you're like, I think this is something I want to investigate, throughout this presentation, and I can give a copy of this to Jan, I've got lists like this of things that you may want to check or research or ask a question about. And it could even be asking a question to another unified group member to help get into that information. Next up, I'm pulling a leverage ratio, and I'm pulling one of my favorites, debt to equity. Again, winning at life. Debt to equity, 3 or under is considered good, healthy, where you want to be. 1.2, there's nothing to talk about. This is awesome. You guys are doing great. This says to me that everyone in the unified group really works hard to maintain a proper debt to equity, and that is really more than just one thing. It's not just debt, it's also equity. So how do you affect a debt to equity? Well, it can be payment terms, pay off quicker. Sometimes it's fixed asset utilization, but most of the time for our contractors, it's usually a component of equity. It's either a component of making money and retaining it, controlling distributions, or sometimes even contributing money to get to the ratios that they want. Okay, I'm moving into the profitability ratios, staying on that same 5th page in your benchmark and the second group, return on assets and return on equity. Years ago, like maybe 10, I was told that the most important ratio in the whole entire world was return on assets. Now, everybody can have their own opinion. I was like, yeah, I don't know about that. I mean, that's a nice one, but it's probably not my favorite ratio. And the reason why is because it depends on the industry that you're in. In our HVAC piping plumbing industry, return on assets is certainly interesting, but we have a mix between companies that have a big shop and some vehicles on the road. Depending on how you mix between having a lot of equipment versus maybe only vehicles and a couple lifts will depend on what you expect out of your return on assets. I would say generally we do run around a 10% return on assets. So one way to think about that is if you have a shop, you want to be able to make at least 10% off of your shop operations. If you have a lot of vehicles or maybe a large service department, you want to be able to make at least 10% off of that vehicle. So you've kind of convert everything to what's going on in the asset world. When we look at return on equity, you see that we've dropped over these past 3 years. And at first blush, you might say, oh, I don't know how I feel about that. That's not very good. We want to have a strong return on equity. Yes, but as we saw on our balance sheet, we are experiencing an increase in the equity section. When we have an increase in the equity section, we're going to have a decrease in our return on equity. I really think this is more about managing equity than the return, because as we see on the income statement, you guys are producing net income. There's our net worth again. I just wanted to show you so you could see how that would work on the return on equity. On our return on assets, if you want to increase it, you're really going to look for utilization of assets. Is there anything on our asset list, anything in our shop, any vehicle that we're just not using to the full extent? And then you can sell that. If you have debt against it, you can also affect your debt to equity. On the return on equity, we're back to this whole control of equity conversation. How do we want to distribute money? How do we want to make and retain money? And you see this make money. Well, you know, isn't that always the game? I put a smiley face because it's even pretty funny. Oh, of course we want to make money. Isn't that what we do? Okay, now we get to do Shane's favorite, the income statement. So I'm going back. This is the 3rd page in your benchmark. So you have 2 balance sheets and then the income statement. I've given you the summary of the income statement. We'll look at a few detailed statistics in a minute. The story I want to talk about on the income statement is about gross profit versus overhead, and I'll start there. Of the questions we get about the benchmark, one of the main ones is, I look different in gross profit versus overhead or SG&A. This is the fun of construction. We have companies that treat what is a job cost versus what is overhead very different, and I'm going to just give you one example. One example of how this can manifest itself is if you have a project manager and you say, I want my project manager to code all their time into job cost. So that's going to be above the line. It's going to affect our gross profit. Versus another company would say, I don't want to put any project management salaries in the job cost. I put them all in overhead. So that means that company would have a higher gross profit and a higher overhead. We have had this conversation in the financial forum as well. How do we allocate expenses? This one small example actually is project management, but there's a whole list of costs that each company might handle differently. If you think this would be another good topic for our financial forum in a year, please let Jan know. This has been one of the conversations that we return to multiple times because there are differences, and the differences are not bad. These are just fine differences. The issue is just to recognize that there is a difference so that you know how you actually are comparing to this benchmark. And you see we have another strong year for net income. As a general rule for net income in construction, in my little world, if you're making 2% and above, you're doing just fine. This is back to this healthy version of a company. Now, 3.9 compared to this awesome year in 2016, we might be like, well, dang, I like this year better. Well, yeah, me too. But we're still performing well. We're still healthy. We're still doing just what we need to be doing. There's nothing to feel bad about there. Okay, I have an ask. This is my ask page. I am investigating. I don't know if that's the word we want to use, but I am intrigued, and I've got an itch I can't scratch, and it's all around throughput. Throughput as a general rule for me, for my definition, is all about how much work, what type of work, how does it push through the organization, and how do we change it? How do we get more out of the limited time and money that we have so that we can produce the highest profit? So this throughput is a calculation of gross profit divided by direct labor hour. What I want is I want this throughput to magically align with net income, and all the planets are perfectly aligned and everything works. I have to believe that somehow throughput, or gross profit divided by direct labor hour, could be a wonderful not only lagging but also goal indicator for us as we look at work that we are considering or bidding, or how we even put a job in. I would love, love, love to know if any of you are tracking this on a consistent basis, and if you would be part of my challenge group. The challenge group is for 1 year. Can we track this? I would like to know how this works and how this runs through the financial statements. So what my goal is, I'm going to take a couple of contractors, handful of contractors that we have, and run this gross profit per labor hour for 1 year. And I want to see what happens. I want to see if there's a relationship that I'm hoping for and my fingers are crossed for. So if you want to be a part of that, I would love it. And Jan has my email. You guys can keep me posted on your progress, and I can do the same. But I'm just insanely, insanely curious about it, and maybe you guys would find it interesting too, because, like, you're my people. This call is my people. So hopefully there's somebody here that's like, yeah, I'm with you. Because I'm so fascinated with this throughput, I've really been thinking about how you affect change on the income statement. Income statement is a little different whenever we think about affecting it, because we usually see the effect of our changes much faster on the income statement than we do on the balance sheet. We go get a whole bunch of work, we immediately bump up our revenue and hopefully our gross profit as well. But when we look at the income statement, it's really a function of multiple things. It's a function of volume. How much work can we push through our system? What is the profitability of the work that we're pushing through, but also job mix. So when we think about levers on the income statement, it's not just simple. It's not like, oh, well, we just got to go get more work. Well, yeah, that's the easy answer, but it's actually more strategic than that. We have to think about how each one of these pieces fits into the larger framework of our organization, and we may actually be able to get more throughput on focusing on job mix than even on volume. I'm going to leave throughput alone because I would love to talk more about it, and I would love to have some feedback on it and see what you guys are tracking, but I'm a little obsessed. I have a natural tendency to get a little obsessed. Okay, I'll leave it alone. Okay, construction and service. We are so fortunate to split out construction and service statistics. If you have that information in your organization, this is a great place to be able to compare it, contrast it, and think about how you fit within the unified group as a whole. one of the main reasons we wanted some benchmark data within our unified group is we would be able to pull some of this granular items out, like a simple split between construction and service, and then even get into headcount and some hours. So we're going to look at those in a minute. We thought that that would really be beneficial to us as peers, because now we can have a more detailed conversation, because now we're really getting into job mix. Now we can start talking about some of the more underlying causes of how things work in organizations. And as you can see, we are very consistent as a group, about 75-25 as a total group. However, when we get into our group of under $10 million contractors, you're going to see this variance. So if there is an under $10 million contractor on this call, expect to see variances in this mix, and it will also show up on that income statement for you. We'll sometimes get some questions in our smaller 10 million and under, because they tend to have quite a bit of service work in those companies. So if you are one of those and you want to go through your benchmark in a little more detail, just holler at us. We'll be glad to talk about it. Okay, we are moving into some statistics, and that is on page, okay, well, it's kind of spread out, but I'm going to focus mostly on page 6. So it's after the ratios, as long as I have my pages still in order, and it has items like total company statistics per employee and then a percent head count. So I'm working off of this page for the most part. I've got a few. I'm kind of pulling from a couple of different places. Sorry, but you'll follow along. We've tracked this revenue per tech and revenue per construction worker now for almost 5 years. We actually took a break in 2015. That's why we don't have that data. And we did financial metrics only, just the big stuff. Can you see how this is working? We are very consistent again in these 5-year trends. So if we had to, look at this chart and close our eyes and say how much should a tech bring in revenue per year? 300,000. It's a number. Of course, we're going to have fluctuations based on where you're located, but it gives you an idea of what is normal. That can help you understand when you're short-staffed. Aren't we all short-staffed? But when you're short-staffed, or maybe whenever you have a tech that's not performing up to their capacity, and it could be something just like we need to look at what they're being assigned. Also looking at the gross profit per tech, this is, again, great information, and we can just say it's $100,000. So this points directly to how we're doing for gross profit, how much revenue we're controlling per tech, how much we're bringing in, and now how easily can you think about building a service budget for the year? You could count your people and do some rough math and get at least an idea of what you're looking at for revenue streams. Revenue per construction worker is also very consistent, which I'm so happy to see all these years. It really gives us an idea of what the trend is. And it also tells us that we can rely on the information. We're not seeing that it's all across the board. We're seeing some real consistent information. Digging in a little bit into some more per employee statistics. This first one is one of my favorites, construction revenue per project manager. This was tough for us. As contractor, it was always hard to determine the right mix of work for our project managers. Some years we would have one project manager. Well, I can remember one year we had a single project manager do $21 million worth of work. Here we're looking and saying that on average, our project manager is responsible for about $4 to $5 million in revenue per year. And we can also see it's pretty consistent across all of these years. So how much revenue can our project managers manage? Well, if we use this, somewhere between 4 and 5 million. Likewise, we see that they are responsible for bringing in a certain amount of dollars into the organization as far as gross profit. Moving into the service revenue and salesperson, this one's so interesting. Look at the growth in what a salesperson is bringing in, or at least how the service revenue is relating to the salesperson. It's double from 2014. Why is that? Well, I don't know. I don't know what's happened from 2014 to 2018, but if you look at the 2016, 17, and 18, it's certainly more consistent. We're going to call it about $3 million. That tells us how much we can expect our salespeople to be responsible for, and it also gives us an idea if we are ready to add somebody or maybe we have a performance issue. Such great statistics for operating the business, not just looking at the financial statements. Okay, I'm moving into overhead. So you can see we're drilling into our income statement, and now I'm into the overhead section. We could have fluctuations because of how people allocate their costs, but we're running 16%. I think this is a great number. I like the 16%. Whenever we were back at the 20% mark, it could have been an allocation, but 20% tends to be on the higher range of what we see for HVAC, piping, plumbing contractors. Usually somewhere 16 to 18% is pretty consistent. Overhead is one of these topics that a lot of people like to opine on. We will get our project managers maybe, or sometimes salespeople saying, well, we just have too much of it. And what we have certainly learned is that the biggest part of overhead in an organization is understanding what the expectations are. So I'm just going to pull back here. If we have the expectation that it's always 16% of revenue, well, that's great. That's a number. That's something that we can start with. But what if we grow revenue? Or what if we decrease revenue? How does that change? So I like to encourage people whenever we get into overhead to start thinking about it more as expectations, or what do I expect to have in my vehicle account? What do I expect to have in my office supplies account? More so than just this general number that always works. Of course we want that. Of course we want to be able to communicate that. But this opportunity that we have as accountants in the organization allows us to not only set expectations, but it increases trust in our organizations and our companies and our teams, because we are setting expectations, and then they can trust the expectations because we can prove it. This is why I like overhead budgets, is because it sets expectations that then we can prove out, and then we create trust. It's a simple piece that allows this trust to be built. We have just a few items in the benchmark that specifically address overhead or some numbers that you may want to use to create expectations. I'm not pulling all of them. I'm just giving you just a few. I always enjoy looking at work comp and EMR. You can see we've got a great EMR as a group. Our premiums have really stayed in check, considering how crazy some of the world has gotten on some of the insurance premiums, but everything here looks good. As I think about how to use work comp, EMR, and creating this expectation and trust, this conversation talking about how much do we spend in insurance premium for work comp and GL is always a shocker for people. They just didn't know that that's how expensive things were. So by establishing this is how much we spend on it, and then that's how much we spend, we've established not only expectation and some trust, and we've educated. Vehicle expense is something that we do see a bit of fluctuation on, specifically related to fuel. So if you have a separate fuel account or you put all of your fuel all into a vehicle account, that can adjust your number just a bit. But again, we're very consistent with how much we spend per vehicle. This would be another one where you can use for creating expectations. How much do we spend per year per vehicle? Well, $6,000 to $7,000. We can also then take that into that direct labor hour and figure out some costing pieces. Getting into more of the levers on the income statement, and now we're in the overhead section. So again, this is the one that I hear, oh, well, if we just had less overhead, oh, that's how we'll fix it. We'll just get rid of all the people. Over the years, I have not seen a company save themselves into profit. Now, that's a big statement. I'm not talking about, boy, we cut a little bit and we got to where we were making money. I'm talking about the catastrophic. We just took 50% off of our revenue this year, and we're going to take 50% off our our overhead. We actually had a company this year that had a substantial change in revenue, and they could not save themselves into the profit. They had built the machine that operated at a certain size, and it's very difficult to cut until you can save yourself into it. As a general rule, I tell people that if you're getting $50,000 out of overhead and you already ran a pretty lean shop, you're killing it. Understanding normal or expected has actually been better for most of our contractors than trying to figure out how they're going to save their way out of it. But even more than the overhead conversation is the conversation on revenue mix, profitability, and actually growth of revenue. And the way I usually think about this for me is like my personal budget. So if Shane and I are going to try to control overhead in our personal lives, we might say, let's get rid of Netflix. But in the big scheme of things, Netflix saved us maybe $13 a month, but it would be insignificant comparing to getting a raise. So getting a raise brings that revenue right into the organization or into our household, but Netflix only saved $13. Although overhead can be a very hot topic and people like to bash it, especially then bring the accountant in and see if we can get the accountant to find ways to save us overhead. If we can figure out how to use that time to set expectations, and then revenue is way more fun to talk about, and it actually gets us more where we're trying to go. Our final ratio today is our Z-score. Z-score takes a whole bunch of different pieces within our financial statements and boils it down to one snazzy number there at the bottom. So we're looking at working capital. We've got our equity coming in here. We've got all these different pieces that feed into this total Z-score. A 3 is considered healthy. You can see we have really increased it over last year. Last year we were at 4.7, at 5.5. That's a lot of strength. But if you look down that line, every one of our numbers increased. Now, sure, we had more people contributing, so some of that is just adding additional people, but we increased the score as well. So we're seeing some real strength within the organizations. We've got that strong equity that we already saw. We're seeing some strong working capital. So this is very exciting as a group. You should feel very good and pat yourself on the back for just a minute to acknowledge that what you're doing is working. So a lot of people ask, hey, I don't want all the ratios. Whoa, just give me a couple. So I'm giving you my favorite. And these have been my favorite for probably, I would say, only maybe 2 years. They change. And you already know that I'm considering this throughput, so I put it on there in case you want to join me. I've picked these 3 consistently for multiple reasons, but one is current ratio helps me understand working capital. It's pretty easy to do. It's right on the financial statement, so it's simple math. Debt to equity is another one because I get to watch the equity section. I get to watch that liability. And then I have to say probably my favorite is average months in backlog. And I put that I like to see 4 months in backlog. We run 6 as a group. Again, so much strength within this group to have 6 months of backlog. I have yet to see someone go under, I gotta say this right, I've yet to see somebody that had too much backlog and then not be profitable. I have seen whenever they drop to like a 2.5 on their average month of backlog, have trouble meeting their net income goals. So that has become a good indicator, and I'm sure you guys have your favorites, and I would love to hear your favorites. That would be very exciting for me to know what is important in your organization, what really tells you how the company is doing. And if you want to join me on the throughput, I would love it. It's something that is going to get me all nerded out for this next 12 months. So I hope you've had a chance to at least mark 3 or think about 3. And if you haven't, here's your time. Just jot them down, put it on a sticky note. And in 1 year, we'll all get together for the financial forum and we can talk about the results of the 3 that we picked. You don't have to, I'm not going to be like a really busting you up over this. If you decide to change midway, I'm cool with that too. But I would encourage you just to pick a couple, pick 3, see what they look like over the years, see if it tells you anything. Okay, if there's any questions or ideas or things we want to talk about, I would be happy to do it. I think I saw a little, Jan, I think I saw something kind of flash on my screen, but it's gone.
Can you guys hear me?
I can.
Okay.
Yeah.
I had a question. Just to let you all know, we will be printing the benchmark for the owners and bringing them to the forum. So you guys do not need to send a copy with anybody. And then I have another little question. Gretchen said she thought tracking the throughput is a great idea. She's in.
Yay. All right, Gretchen. We can make Shane do it for you.
I was going to say, don't you already have all that? You probably already have all that from me.
Probably do. I wonder if we have your hours.
I don't think you do, but I can, yeah, just let me know what y'all need and I'm in.
Okay. All right, that'll be fun.
Yeah.
And does anybody have any questions for Melissa?
I thought I saw something in the chat. Maybe it came across in the chat. I think it said backlog. I don't know if you can see it, Jan, but I don't see it.
I don't see
it.
I see one from Gretchen asked me personally about the copies, so I thought I'd share that with everybody because I'm sure everyone was thinking that. And then I just see one from Gretchen about tracking the throughput. I don't see any others.
Okay. I thought there was one about backlog and maybe a question on how do you calculate backlog. For me, the easiest way for me to calculate backlog is on my work in progress schedule. I actually add a column clear to the right, and I put revenue backlog, and I also do gross profit backlog. So if I'm in a pinch and I need to make some real quick calculations or decisions about how that company is going to do, I just pull it right off that job schedule, and I use that for my backlog to goal revenue.
Melissa, this is Gretchen.
Yeah.
So I did have a question on that last slide. You had the statistics or months in backlog.
Yep.
How do you calculate that? Because I'm noticing a trend. Our backlog is dropping.
Yeah.
So we typically run about $7 million of backlog, and we're down to about 4.5 right now. So how do you calculate that into months? Is it just our average monthly revenue, or?
Yeah, on this one you can do average monthly revenue. Whenever I do it, because those that know me know I'm kind of a simpleton. So whenever I'm doing it, I'm doing just my total backlog divided by my total goal backlog, and I want that to be over 33%. It's the number.
Okay.
But in this particular one, I use the average backlog in months because that's the way it's showing on the benchmark. And that is, I actually had to go get Shane and say, where's that again? Because it's kind of, and I'm pretty sure he even gave me an eye roll over it. Like, really? It's right in front of you? Because hang on, okay, there's 2 places. So I think this is going to be page 3. It's about a third of the way down the page. It says backlog and labor hours. So right. There is total backlog. So this is just saying how much do I have just in dollars. And then I thought there was, one that he did in months. No, I'm not seeing it. So what I would do is take my goal revenue divided by 12, and then how many months can I cover in my backlog.
I got you.
So
okay.
That would be kind of a simple version there.
Okay. Thank you.
You betcha. Anything else? Well, thank you for spending some time with me. I hope you were able to use the time and get into the benchmark and hopefully highlight just a couple of ratios that you can track this year with me. And we'll get back together in a year and we'll see how we did. Hey, Dan.
Thank you so much, Melissa. Great overview. Looking forward to some of the...
Hey, Dan and Melissa, I had a quick question.
Yeah.
When are you going to ask for our 2019 data? Are we going to have it in time for the financial forum in October?
Yep.
We should, if everyone gets me their info. I mean, I 4 months later, I'm still bothering people. Like, I hate to run it when I'm missing so many. So,
Yeah.
we usually send it out, I think, in March, April, and I give it a month, but there's a lot of people that I wait on. We got it for now. I mean, we got it in time for this call, and this is the exact time around next year when we're doing the meeting. So I'm hoping we'll have it a good 6 weeks, 2 months ahead of time.
Yeah, I was going to say, you know, given the financial forum is next year, maybe everybody will get it in sooner so they can get it included.
Be ready.
Yeah, yeah.
Mm-hmm.
Okay, that's all I had.
Thank you, everybody, for being on the call. Thanks, Melissa, for the great overview. We're looking forward to seeing you next month, giving the owners a little benchmark lesson, as well as seeing you guys at our financial forum next year. And we will get a task force together to get planning on that one as we get a little bit closer. If anybody has any questions, please feel free to email me, and I can pass them to Melissa, or I can connect you to Shane or Melissa. Either way. And thanks, everybody, for your time. We really appreciate it, and great job, everybody. All good stuff going through there. We're doing great as a group. Pretty impressive.
Yeah.
Thanks,
Good job.
y'all.
Thank you.
Have a great day.
Bye.
Thank you. You too. Bye-bye.